Good afternoon, ladies and gentlemen. My name's Stephen Fletcher. I'm Head of Retail Distribution at GSFM. And on behalf of all the team at GSFM and Munro Partners, welcome to the Munro Partners webinar today with CIO Nick Griffin. We actually had this week in October penciled in for the Munro National Roadshow. So this week we're actually supposed to be flying around to all the different capital cities. I can certainly tell you as a Melburnian that there's no place I'd rather be right now than presenting this to you face to face. But for obvious reasons, we can't be there today, but we certainly look forward to seeing you all again in your capital cities when we can. We're certainly delighted to have with us today more than 600 attendees on the call. So I'd just like to say thank you all very much for making the time to attend today. Nick will provide a business update shortly, but I can tell you that the assets within the Munro Global Growth Fund in the Australian Fund have grown dramatically throughout 2020. So can I just say again on behalf of GSFM and Munro Partners, thank you for your support. It's been fantastic. We very much appreciate it, and we look forward to working with you with the many years ahead. So the format of the webinar today will be a Q&A style presentation. We regularly get feedback after these types of presentations that it's actually the Q&A component where clients get most value. So we thought, why don't we address some of the questions we're getting from our advisors out on the road and run them through as a webinar today. After the formal Q&A session, we will allow you to ask questions and we'll endeavour to answer as many of those questions as we can in the time that we have allotted. So on the bottom of your screen, you'll have a Q&A box. Please submit your questions throughout the presentation. And as I said, we'll get around to answering as many of those as we can. Now, I'm pleased to be joined by Nick Griffin. As I said, Nick is the Chief Investment Officer at Munro Partners. He's also a co-founder. So Nick, first of all, welcome to you.
Thanks, Steve. Good to see you.
Before we get into the Q&A, Nick, we also have some exciting news around the upcoming launch of the Munro Active ETF. So maybe as a way to kick things off, if I can hand over to you to provide maybe just a short, brief Munro business update, maybe now's a good time to talk about recent performance and also portfolio positioning. Thanks, Nick.
Yeah, thanks, Steve, and thanks everyone for dialing in. And so as Steve said, we will try and keep this Q&A formatted, but we do understand that there's probably a lot of people dialing in for the first time or seeing us for the first time, and also we understand obviously we have retail investors on the call. So importantly, it is important that you take the time to look at this disclaimer or to read this disclaimer after the presentation. But importantly, we are offering general advice here, and we're not making specific stock recommendations as we go along. So look, just in terms of a quick business update for Munro, and just to remind people of who we are and what we do, and because it will set up the Q&A for a bit later. So I'll go for about 10 minutes here if that's okay. But we are a global investment manager, and we have a growth equity focus. We set the business up in July 2016, and our goal is really simple. We want to be Australians' global growth investor. We understand that equities is a game of very few winners and lots of losers, and your goal is to find these few great growth companies. And while there are lots of great companies listed on the Australian Stock Exchange, in all probability they're probably going to be outside of Australia. And so that is the problem we are trying to solve for our clients generally. We established the business, as I said, in July 2016. We're proudly Melbourne-based. It's a tough thing to say right now, but we are, and that's why you're seeing me here in my study today. Fund's done roughly 17% per annum since inception in the 4 years that we've been running it. And we now run we now run over 3 billion in assets under management. And so many of those assets that we've garnered have come through our friends at Grant Samuel, but also through our friends in Canada, and many of you are on this call today. So we do appreciate that support. Just moving forward, just to tell you a little bit more about us. So what are we doing? With the business is continuing to grow. It's important to remember that we are a partnership. We are proudly Melbourne-based, and so everybody who works at the firm shares in the profits of the firm. We're pushing up through 14 people now, and we're continuing to invest in what we do, not just with how we find these great growth stocks, that's very important to us, but also how we access the market and the different products that we bring to market. And so we have a very strong operations and investment management team, and these are things we want to continue to build on for years to come. And we do think we can get better at what we're doing into the future, and we hope that that is the case. And the partnership model is really at the core of that. Just to quickly give you an update as to those new products, as Steve mentioned there, we do run 2 products here now at Munro Partners. So we run the Munro Global Growth Fund here on the left. This is the flagship product that we launched on day 1, and it has the 4-year track record that I referred to previously. This is our absolute return product. This is a product that's really designed for retail investors or for people who generally want to access great global growth companies, but they want some downside protection. And so this product has the ability to go up to 100% cash. It runs with a lower beta than the market. So it has these downside protection tools. I'm sure this is going to come up in the Q&A. They've obviously worked well for us in this last 12 months, but that's what that product does. And this is the product where we are looking to launch a quoted ETF on the Australian Stock Exchange. And so the guys at Munro, we have to thank them for they've been working very hard to launch this product. It's going to be called MAET, and it's going to be quoted on the Australian Stock Exchange before the end of the year. And what we're hoping here is that's going to allow more people to access what we do, to access, to basically look outside of Australia and find these great global growth companies. And we want to say thanks to the guys at Munro, and also thanks to our friends at Magellan, who, to be honest, have forged this path for us. They've done a great job in trying to get managed products onto the exchange, and we think that's going to be a very important thing for Australian investors into the future. The second thing we wanted to flag on the right here is we have also launched a long-only product. So many people just want our best ideas long-only. They don't want the capital protection tools. And that product has been actually running for 4 years internally, or for institutional clients. We've launched that as a retail product just in the last 9 months. And so I'll talk a little bit about that today as well. Look, the last thing just to flag is just because this is again going to come up as we talk today. What is the key difference between these 2 products? And this is really summarized by this slide here. I mean, ultimately the stuff in white is what we do and what the long only product does, and what every other manager in the world does, which is you effectively have an investment team that follows an investment process. It does active research. We happen to be a growth equity manager. There are value managers. There are bond managers. That's what our long-only product does, and that's what we do in both products today. It's just the long-short product, or the capital-protected product, has these other things in yellow, which is the ability to short sell, the ability to buy things like put options, or the ability to hold cash. And that just allows us to really focus on that thing that we think most people want, which is absolute returns, whereas the long-only product, as I said, is just relative returns. Okay, and then lastly, just in way of introduction, I just wanted to just really quickly touch on our philosophy. I know there's people on the call who've probably seen this before, but I just wanted to touch on it quickly because it's just going to be important in terms of how we set up, how we look into the future. And I know that's what people are here to look at, but how we're thinking about where we invest in this post-COVID-19 world. And so our philosophy is we are effectively a growth manager. We do think that earnings growth drives stock prices. This is how we make money. We find that companies that make more money every year, we find their share price generally goes up. And we also find the market is offering mispricing this growth, or the sustainability of this growth. And again, I'm sure we'll talk about this a bit today. And what to try and show this to people, we show 2 examples. One here on the right is Bank of America, and the one on the left is MasterCard. And what we're showing you in black is the share price of MasterCard and the share price of Bank of America. And the blue line, we're showing the 12-month forward rolling EPS. So that's the earnings expectations. And all we're saying here at Munro is we just don't have a lot of value to add on this Bank of America situation. It relies on the economy. It relies on interest rates. It relies on a whole bunch of things that basically we have a view on, but our view is as good as the last 6 webinars you've been on. It's a macroeconomic view. Over here, we do feel we have an edge. MasterCard is benefiting from the shift from physical to digital cash. This is a structural trend. And what's fascinating about this one, and we use this example a lot because we've used actually the same example now for 4 years, is that everybody knows this, but the market's incapable of pricing it in, and it can't price it in because it's structurally accelerating. And that's the situation we look for time and time again. That is what our process is designed to do. And the last just introduction slide around our philosophy is really just to think about, why do we focus on this? Why is this important to us? And we just think it's all that really matters. The equity market is horribly overanalyzed, in our opinion, and horribly misunderstood. Equities is actually a game of very few exceptional companies and thousands of really average ones. And your goal as a growth investor, or as your goal as any investor, is to find those few exceptional companies. That is your goal. And so you'll see a lot of people sort of talking about being over and underweight certain sectors because the economy is going to be this. We just honestly think that's a waste of time. We think sectors are a waste of time, and we also, to a certain extent, think the index is a bit of a waste of time. What you're actually trying to do is just find these few winners. And we're going to talk a lot about it today. On this slide, all we're showing you, and you can go back and have a look, is a study that appeared in the Journal of Financial Economics that sort of proves this point. It's done by a guy called Henrik Bessenbinder. And he said, what would happen if you bought and held every company that ever listed in the United States over the last 90 years? It ends up being 25,000 companies. And if you bought and held every one of them, you'd discover that more than 14,000 of them, so 60% of all companies, actually go to zero. So most equities go to zero. Most equities just go broke. The next 8,000 only make enough to offset what the other 14,000 lose. And you end up with just this very small subset, less than 1,000 companies, who've generated the entire wealth of the US stock market over that time frame. And the top 50 of those 1,000 companies that we've plotted here make up nearly 50% of that entire wealth. So that's 50 companies out of 25,000. Now, importantly, we know who all these companies are today. Like, we know who they are because they have effectively, they're household names. But the reality is there's very, very few of them, and they're all driven by structural change. Whether that's more recently in the digital transformation, being Amazon, Facebook, and Google, or in software with Microsoft and Oracle, or in big box retailing with Home Depot and Walmart, or even all the way back with Altria and cigarettes and Boeing in aerospace. These are the few that you need to find. And our job as your growth investor is really to occupy this top left-hand corner and try and find those companies. And I'm sure we're going to spend a bit of time talking about that today. Okay, so then lastly, just to talk about how we're positioned today, and then I'll just finish with a bit of performance, as Steve says. When we're looking for these structural trends, we're essentially looking for these types of situations. And we're going to show you some of the structural trends we like today. And we showed this situation because this is the one that everyone understands. It's the mobile phone market. So Apple just on Tuesday launched the iPhone 12. Well, all the way back here, they were launching the iPhone 1. This is the mobile phone market in 2008 to 2018. Mobile phones don't actually grow. You go from 1.6 billion phones to 1.7 billion phones. So you don't actually buy more phones through the site over the last 10 years. You just keep replacing your phone every 2.5 years. Phones don't grow. The economy doesn't grow. But smartphones go from a 10% share to an 80% share in a 10-year period. And Apple goes from literally 100 billion in market cap here to now 2 trillion in market cap today. That's the structural trend you're trying to find, and that's the structural winner you're trying to find. That's the goal, effectively, of our process. When we look today in terms of how we've positioned the fund today, these are a number of the structural trends that we've been following for some time now. It's exactly the same concept. What I'm showing you at the bottom here is the shift to e-commerce in the US, where you've effectively taken 20 years for e-commerce to go from a 0% of retail sales to roughly 20% in 2020. It's the same for digital payments that I talked about earlier, that have gone from effectively 35% of all sales in the US to now 60% today. It's the same for digital advertising. It is the same for cloud computing. These are all areas that we were looking at prior to the COVID crisis. As COVID has come along, and I think most people are familiar with it now, this has accelerated, and in many cases accelerated dramatically. And so from that point of view, just think of Amazon. Even though the pie has got smaller because of COVID, i.e. we're in a recession, e-commerce's share of the pie has got dramatically bigger. It's grown nearly 7 percentage points of share in just 1 year. And Amazon's shares got even bigger. And so when we do the maths on Amazon, we mathematically come with significant upside. It's the same for cloud computing. It's the same for Zoom. It's the same for digital advertising. It's the same for digital payments. All these areas are accelerating in a post-COVID world. Now, when we showed this chart last, it was actually back in April when we did our last webinar. And at that time, the market was down, and these companies were great opportunities. Since then, they've done well. And a lot of people are probably wanting to know if we still think they'll do well, and the answer is yes. The answer is yes, these stocks have done well. Yes, they may subject to short-term pullbacks, but we would point out that these trends are accelerating. And if anything, all the companies are showing is they're just indicating the pull forward of demand we've already seen. the longer this goes on, the more demand will be put forward and the more upside there is. And even if the world went back to normal tomorrow, ultimately, we just don't think that a lot of this pull forward is actually permanent. So if you think about Zoom, you know, the reality is, even if we could fly tomorrow, we'd probably do more things on Zoom going forward. And when we plug those numbers into our models, we still get more upside for many of these companies. And so from our point of view, we're still very much positioned in these areas. The second and third areas I want to talk about quickly today, which I'm sure will come up, is where else we've gone to in a post-COVID world. And so the other big area we've looked at, and this is showing biologic cells, but is healthcare. Healthcare is actually the biggest weight in the fund today. And so when we look at this crisis, we see a number of companies that not only just benefit from the testing that's going to be required to help us live with COVID, but also the building of the vaccine that's going to help us, you know, obviously get through this crisis. And then more importantly, these companies are actually going to help you prepare for the next one. And so our biggest area in the fund today is actually an area we call innovative health. And I'm sure that'll come up a bit today also. And the last area we wanted to flag is really a new one that's coming into the fund at the moment, is really around climate change. And so this is an S-curve that's right at the start. And so I think the interesting thing that's happened in a COVID world or a post-COVID world is that, you know, climate change or decarbonisation of the planet has actually become more important. And the fact it's become more important means that we see this actually accelerating. And so this is an S-curve that's right at the start, and we've got some very nascent ideas here that I'm sure we'll talk about. Putting that together, and I just wanted to flag in these last few slides, just to try and help you read our materials that come out, whether it's our monthly or our quarterly, so that you can actually just keep up with what we're doing. And this is a slide that appears literally in every monthly note and every quarterly note. And it just shows you these are the areas of interest that we've got the fund positioned in. What we're showing you here is, as I said, innovative health is the biggest. It's roughly a 17% holding, and digital enterprise below that. And what we're saying here is 17% of the fund is in 5 companies, of which Thermo Fisher is the biggest, but we'd also add things like Danaher and Lonza. Digital enterprise or cloud computing is our second big bet. It's 5 companies, of which Microsoft is one, but also includes things like Atlassian, ServiceNow, Adobe. E-commerce we've discussed, digital payments we've discussed. Climate, as I said, is a growing area. We have 6 ideas here. So smaller ideas because we're getting more confident with them over time. And lastly, down the bottom here are some real weapons manufacturers in the wars that we see. So high performance computing is semiconductors, and connectivity is just the way we connect to the internet, because we know that technology is going to be really at the core of how the world grows in a post-COVID world. In all these areas, we see strong structural growth ahead. And in many of these areas, we are, you know, hopeful that we've got the right investments to benefit from that. Okay, so lastly, just in terms of how you would see that. So not only do we update that in the monthly and the quarterly, at the end of every month, we also show this. This just shows you the fund. This is the Munro Global Growth Fund. So this is our absolute return strategy, roughly 85% invested. You can see down the bottom. Delta adjusted 79. That means we do have some put options on at the moment, and I'm sure Steve's going to ask about these. In terms of currency, we're 50-50 hedged, Australian dollar, US dollars, and here's your top 5 holdings. In terms of performance of this product, funds obviously had a good year. It did very well through this first quarter period, so we protected very well through the COVID period. And then we've managed to invest, as I said, well in these companies that we think will be net better off in a post-COVID world. And so we had a strong financial year last year, and we've had a strong start to this year. Look, when we look at this slide again, I just wanted to flag, you know, you'll notice the market's not on here. It's a bit of a contentious issue with the marketing department, but we really want people to focus on the absolute returns here. We really want you to focus on this number here. Double-digit per annum returns through the cycle is what we're trying to achieve. That's what we mean by meaningful adjusted return, meaningful risk-adjusted returns. And at the moment, we're achieving that. And also, we're doing it with a lower beta than the market. And so even though the stocks we're investing in higher beta, the actual fund is lower beta. And so that's why this is that absolute return product that's really very suitable, particularly for retail investors or retail investors who like most I find, generally don't like losing money. The long only product is this one. So this is the one we update. So this is the same ideas, but just fully invested. So 96% invested today, very little cash, and fully unhedged. So no currency hedging back to Aussie dollars. And so from that point of view, this is our relative return product. Here we're happy to compare it to the market. It too has also had a good second quarter and a good year. But interestingly, the absolute return fund's up more than 30% for the year. The long-only product's actually just below 30% for the year. So we have actually outperformed with the absolute return product, and that's really because of our ability to protect capital through that first quarter. So yeah, that's the end of my short introduction. I hope I didn't go too long. About 10 minutes longer than I said I would. But Steve, maybe I'll let you pry into any one bits you want to go into there.
Yeah, sure. No, that was good, Nick. Thank you very much. So as I said, these questions are coming from advisors that we get when we're on the road talking to our clients. So why don't we start with the market outlook? You know, obviously there's a lot going on in the world right now. The world's still battling COVID. We've got the US election coming up, you know, etc. You've just discussed that, you know, you remain relatively constructive on markets. Why is this the case? Why are you, you know, reasonably positive right now?
Yeah, so look, we agree. It's clearly a confusing time for a lot of people, and it's a confusing time for all of us in our lives. And I think what a lot of people are missing, and so I'll just got a couple of quick slides to show you here, is people have struggled with this for a long time, and we've said this for years. But people need to understand that the equity market and the economy are not really the same thing, and they haven't been the same thing for quite some time now. Over time, this has actually been getting worse. And so if you look at the top 10 companies in 2008, you know, you can see quite a lot of sort of economically sensitive companies, and, you know, a couple of, you know, growth companies. And then if you look at the top 10 companies in the US today, you know, it's very much dominated by these big digital winners. These companies that, as we were flagging, are actually net better off because of the crisis. And so the very, very sad thing about COVID is there was already inequality problems in the world prior to this. All COVID's done is accelerate that. So change that was, as I showed you earlier, that was already occurring at a reasonable rate is now occurring faster. And so what that does is it actually benefits these companies, and that's why their earnings are going up, and so their share prices are going up. But it also means that, you know, that central banks have to keep rates low to support the rest of the economy, to support the vast amount of the economy that's not listed. And it's important to remember it is the S&P 500. It's the top 500 companies in the world. It's not the whole economy. And so what that's done is it's created this situation that I'm showing on this slide, which is you sort of have the Federal Reserve. So this is the investment grade bond market in the US. It's an ETF of the investment grade bond market. And so the Fed used to print money and buy sovereign credits called quantitative easing. That's what they did back in the financial crisis. In this crisis, they've gone a step further and started buying investment grade credit. And so the key thing to notice here is that because the Fed has stepped into these investment grade markets, your standard investment grade borrower can borrow money cheaper now than they could prior to the crisis. And that doesn't make a lot of sense. And so from that point of view, even though you're in a recession, you have these big companies with access to capital who can borrow money cheaper than ever. And they're effectively benefiting from these furloughed industries. And that will have consequences down the track. I'm not saying it won't. But today, you know, what we can see is considerable earnings acceleration occurring here and stuff that we think will continue for a while. The last thing I'd just point out around valuations is a lot of people think the valuations look a bit high. But if you obviously compare them to interest rates, which you should, they're actually not. And so we would talk about the equity risk premium here. And so if we took the PE of the S&P 500 and say it's 20 times, and you did 1 divided by that, it's actually a little bit more than that today, then the equity market in the US is giving you a 5% earnings yield carry. And if you subtract the US 10-year rate, which is roughly 80 basis points, you're getting over 4% of carry for owning equities. And historically, that makes equities actually look cheap. I mean, so a lot of people think this looks like 1999. No, that was 1999 back there, you know, where you were getting no positive carry at all. You're getting a huge positive carry for owning equities at the moment. And so from that point of view, you've got to think about what's going to change this. And look, we understand there's an election around the corner, and we understand there's a second wave of COVID. But in the reality, they need to actually move that interest rate significantly higher, or they need to move earnings significantly lower to break this equation. And we just think on the balance of probabilities, that's not likely. Not likely in a material way to break this equation. And so while, you know, we've taken a little bit of a step back because of the election and the uncertainty, because we don't really know what's going to happen, in reality, the pure mass for equities still looks pretty good.
Okay, so maybe just turning to risk management then within the portfolio, you know, what if things don't go to plan, and should markets, you know, become problematic and difficult again? How should investors expect the fund to react?
Yeah, so thanks, Steve. Yeah, so look, obviously, there's a lot of focus around our downside protection tools. And I showed these earlier. So these are the tools that we can use to protect capital. And it's important to stress that even though I gave quite a bullish outlook for markets, you know, most of the times we're using these things is when something comes along that you're not expecting. Equity markets, you know, markets really suffer when something comes along that we're not expecting. And okay, let's assume COVID's one of those things, okay? I'm more than happy to put up my hand and say I was not one that predicted we would be in this scenario. In fact, I was one that really didn't think COVID was going to be a big deal at all. And so it's really how do we use these tools and how does our mandate allow us to do it? And first and most importantly, we have a mandate that lets us do it. And so what we're showing you here is, yes, we can hold up to 100% cash. Yes, we can buy a put option. Yes, we can short sell. Yes, we can move the currency around, but really it all revolves around this capital preservation mindset. It revolves around there's something's happened that we didn't think was going to happen, and now we need to do something about it because we have to protect that downside. We have high watermarks in the fund. What I'm showing you here is the fund over the journey. And so this is the net exposure of the Munro Global Growth Fund since inception. So this is our absolute return product. And what you can see is these large drawdowns in exposure. You know, we're generally running it reasonably long, roughly 80% long, with some shorts and generally investing around 100% of your money. But we have these drawdowns. These obviously compile with the large corrections that we've seen in the market. And what we're doing here is we're not actually selling the whole portfolio. We're just quite simply hedging the portfolio with some of these tools we have available. And what I'm showing you on this next slide is the attribution from those two periods. And so this is the December quarter 2018, and this is the March quarter 2020. Now, in this scenario, the S&P fell around 14% and our stocks fell 14%, roughly. But our ability to short sell and our ability to buy put options on the market and also the ability to move towards US dollars did provide some downside protection, but ultimately the fund had a drawdown. In this scenario, the market actually fell the US market fell 20% in that first quarter of 2020. So this is the COVID correction. And here our put options helped us out significantly, shorts helped us out significantly, and as did the US dollar. Now, when we look forward, I'm actually now finally answering your question. Sorry, Steve. When we look forward, so we're obviously reasonably relaxed about the US election. I mean, provided we get a result, we don't really mind that much. The fund's done well through the Trump era. We actually think it might do a little bit better in a Biden era. We can talk about that in a second. But we don't really mind. But if something goes wrong, then you're basically relying on us to use these tools effectively. It's important to stress that put options probably won't work as effectively as they did through the COVID crisis because the volatility is very high right now. But we could do things like short futures, for instance, so we can short NASDAQ futures to protect the fund, or we could hold some more US dollars. Or more importantly, we can just stop loss out into cash. And so those are some of the tools we can use. There's no guarantee we'll use them well. As this shows, you know, there is varying outcomes, but we do have the tools and others don't. And so the key is really to have the mandate that lets you do it.
Okay, great, thank you. Now, Nick, you've recently spoken about the opportunity for active managers as a result of COVID, but I think it's fair to say that it hasn't been one-way traffic for all active management as a result of the expanding representation of high growth tech stocks within global equity indices. With this large gap forming between, you know, the old and the new, or the high growth and the lower growth, how relevant do you think indices that include both types of companies are today?
Yeah, okay. Yeah, so I think it's a good question, and it's what a lot of people miss actually on this slide, and maybe I'll talk about it. But what a lot of people miss is what was actually happening here, and what happens subsequent to that happening. And so this year is quite unique for that, and this is sort of part of why this did quite well. It's important to remember that when COVID hit, the equity market effectively the ETFs and the futures just sold everything. So they're all effectively attached to a market, and they effectively sold everything. And so the whole market was going down. But what was actually happening in my life and your life is you were canceling all your international travel, and you were rapidly shifting your business to online or to Microsoft Teams. Yet Boeing and Microsoft are both falling the same amount. And the reason why that's happening is because they're both big parts of the ETF, or they're both big parts of the futures. And so what ETFs or what passive wasn't built for? It wasn't built for a situation where the world pivoted. And so maybe if I show you this slide that I showed you before, is is the world actually pivoted. You saw this acceleration happening in these businesses and other areas that were avoided. And so all you had to do as an active management was basically realize you were being handed a gift here and to take it. So I'm sure it's going to be one of the questions that comes up later, but the hardest bit of what we had to do, and I'll show you just going back here, the hardest bit of what we had to do here was not the protection bit. That's reasonably easy to do because we have the tools. The hardest bit was getting back invested again. And I think it was really that realization here that actually these things would accelerate and that the equity market was, effectively passive, was effectively offering you this gift that allowed us to do that. The other thing I'd say about this is the index will eventually take care of this because, as I showed you earlier, the index eventually, these bigger companies get bigger and they end up becoming part of the index. And that's sort of where we are today, where I showed you earlier, 31% of the index is made up by the top 10. And so these companies eventually do become the index to a certain extent, but that was the opportunity for us at that time. Maybe just the last part of your question here, what are we avoiding? It also offered you the chance, in our case, to short sell some of these things. And so we did short sell things in media, in energy, in leisure, in our absolute return product. Most of those we've now closed. And look, I do completely see, and I'm sure people sit on a lot of webinars where people talk about the fact that COVID will eventually go away and that a vaccine will come, and a lot of these areas look undervalued and they could bounce. And I have complete sympathy with that. I completely see that could possibly happen. But I don't think the trend's going to change here. I think all the trend's done is accelerate or pull forward a lot of things that were going to happen anyway. And even if we do go back to normal, and my definition of normal, by the way, for anyone who watched last time, is when we get to go back to the MCG and watch the footy with 100,000 people in there. That's normal, okay? That's still a fair way off. And so from our point of view, these other areas are still going to be challenged for a while, even post the end of COVID. And so from our point of view, the areas, the big parts of the index that you can just quite frankly ignore are things like banks or things like autos, because they're so exposed, unfortunately, to these small businesses that are clearly going to be struggling on the other side of this crisis. And so even though they might get less bad, it's very hard to see a world where they get significantly better in the future.
Okay, so why don't we move along to valuations? You've already spoken about valuations a little bit. Let's go a bit deeper into it. Now, is the number one question we get asked by advisors is valuation. So you mentioned valuations of digital businesses, and I think everyone understands, and you just mentioned that technology has pulled forward, it's been pulled forward by the pandemic, and I think everyone sees the opportunities you're talking about, but they do worry about valuations. So can you talk about where you see valuations today in more detail and help us understand why, as you pointed out at the start of the presentation, why this isn't 1999 all over again for some of these tech names?
Yeah, thanks, Steve. So I'm going to go back to this slide and then I'll try and go into a little bit more detail because the simple analysis that everyone goes through is that they say interest rates are really low, so valuations are really high, and if interest rates go up, valuations are going to go down again. That is the simple analysis that most people do, and you know what? It's right. That is going to happen in the short term. If interest rates did go up, then longer duration assets would probably go down for a short period of time. But it does ignore what we think is really happening under the surface, which is this concept of very few winners and lots of losers. And so what we showed you earlier is, these top 50 companies really make up the majority of the returns of the market. And your goal is actually to find these very few companies. Your goal is actually to find them. And so when you look at this slide, it's obviously dominated by these big digital winners that we've got recently. But back in time, there was always some revolution happening, whether it was the big box retail revolution or whether it was the transport revolution or whether it was, the software revolution or the media revolution. And so from that point of view, we are sitting very much in this digital revolution. There's really not a lot we can do about it. And it's the obvious place to look for these next big winners. And there's some unique characteristics to it that sort of make this valuation stuff harder than it used to be. And the unique characteristics is that it's being driven by accelerating compute power. So what a lot of people miss when they're looking at the revolution we're currently sitting in, when they look at these growth companies, they're really being driven by this non-mean reverting thing, which is called Moore's Law. And in Moore's Law's case, a standard computer chip back in 1970 had 2,000 transistors on it. And Gordon Moore created it at Intel, and it effectively doubles every 2 years. So it goes from 2,000 to 4,000, 4,000 to 8,000. 8,000 to 16,000, 16 to 32. And so it eventually becomes an exponential. And so today, the fastest computer chip in the world is the NVIDIA A100. It has 54 billion transistors on it. Okay, so computers are getting faster at an exponential rate. And so what that means is the value being created by technology is getting faster at a faster rate. And so this is just a simple slide to show you that back in 2000, if you think of the internet as a big computer, Google, when I first touched the internet, it was in an internet cafe, sending emails to my parents to ask for more money, who are probably on this call. But anyway, and so from that point of view, eventually it moves into search, and search basically wipes out every yellow pages on the planet. And that creates $1 trillion. And eventually it gets on your phone, that creates another $2 trillion. Eventually you can send pictures, that creates more money. Eventually you can shop. Eventually it does video. Now we're doing video conferences, right? And so these companies like Zoom are just appearing out of thin air. And it's all happening because computers get faster. Now, if you know that computers are going to get faster, then and we know that Moore's law extends for another 10 years, then it's highly unlikely that this equation is going to mean revert. Putting this into stock talk, so when you're looking at a company these days, what we find is increasingly companies are investing in this equation to profit from it. So these are your top 5 R&D spenders in the world today, and this is their sales growth. And so what they do is they increase their revenue, which makes higher R&D, which creates increased functionality, which gives them increased upsells, which gives them increased revenue. And so these top 5 spenders happen to be your top 5 biggest companies in the world, and also happen to be some of your top 5 performers. On the right here, Apple being the exception, you've got these companies that are effectively shareholder friendly in their way into not existing. They're shareholding friendly in their way to being disrupted. And so from our point of view, this creates this dynamic where you actually want to buy the companies who are actually spending the most money. Because if they're spending the most money, then they're the guys that are most likely to win, because there's actually only going to be a few winners. And so just to show that a slightly different way, this is just a good study that the guys in the team put together, which basically shows you if you took the peak of the market in 2007 to the peak of the market 2020, so the start of this year. So it's a 13-year period, top of the market to the top of the market. So not the bottom of the market to the top. That's what your value investors doing, and that's what they do really well. But we're growth guys. We're just like, we just want to find companies that win no matter what, top to the top. And in that time frame, in the S&P 500, there was actually 66 companies that went up 10 times in value. So these are the things we were looking for. And of those 66 companies, compared to the market here in dark blue, more than 80% of them had revenue growth in excess of 10%. And in fact, more than 50% of them had revenue growth of over 20% per annum. And in many cases, you had to pay a higher multiple. You had to pay 20 times, you had to pay 50 times, you had to buy a loss-making company. And so I understand the interest rate argument dominates this, but in reality, there's something else going on. And what's going on is that a short-term multiple is just quite frankly not going to help you find a long-term winner. You need to take a longer-term view. These companies have to invest to win. They have to invest to win to be one of these few. They have to invest more at the start. And so what you've actually got to do is just do a lot more work to try and work out who those few companies are going to be. And if you just get so myopically focused on next year's multiple, then it's ultimately going to make you do the wrong thing. You're actually only going to be looking at one half of the market, and you're probably looking at the half of the market that's actually not going to do well.
Yeah, I guess that was my my next question. Just looking at PEs. I mean, I think you've just answered it. But how relevant are 1 year forward PEs as a valuation marker on a company that's growing 20% versus per annum versus a company that's growing at GDP? Have you got some examples that you can maybe talk about?
Yeah, so I did think about this one overnight, Steve, because you mentioned yesterday you were going to ask this, and so yeah, we are going to show you a couple of examples today as to how to think about this. But I just want to be clear that this is a this is a retail investor presentation, and so we're not giving stock advice here. We're going to give you 2 examples to show you how we would think about it. Probably give away a little bit of IP here, but how we would think about it, how to get over this short-term multiple issue. But I want to be clear that we're not offering advice here, and either of these companies may not actually be in the fund. But the one that I thought would be most useful to show to sort of help people understand this concept would be Netflix. And so this is a slide that we produced a couple of years ago, actually, all the way back in 2018. And we've owned the company off and on since 2014. And so from that point of view, the thing that everybody knows about Netflix, like everybody gets this, is that over-the-top video is going to be the dominant form of video consumption, right? So as soon as Netflix came along, it became clear that this was a better mousetrap or a better way of watching TV than flicking channels. Netflix would continue to dominate this area, but obviously competition would come, and that over the top would have this huge total addressable market. And Netflix is doing exactly what I just showed you previously, what these other guys have been doing, which is they're effectively, they're spending all the money, spending all the content to get subscribers, which goes viewing, which gives them sales, and they just pour it all back into content to basically win, because they know that there's only going to be a few winners here, and they know that they have to be one of those winners. You're not going to sign up to 20 subscription services. You're going to sign up to 3 or 4 tops. And so the problem is all of this means they don't make any money today. And so it sits there on this very, very high multiple that ultimately turns people off investing in the company. What we would do when we look at this is we would do something like this. So we would do a total addressable market analysis. And the reason why I show this slide is because, or we decided to show this one, is because this is actually the numbers we had in 2018. So these numbers are literally 2.5 years old. And in fact, we had them well before that. And so what we said back then is we said, look, if there's 1 billion internet connected houses in the world, and Netflix is connected to 100 million of them, paying $9.35 per annum, or per month, sorry, what could they actually get to? Not next year, but 10 years from now, all the way out in 2027. And so what we said is, look, well, like best case scenario, you know, maybe let's say 400 million subscribers, or, you know, medium case scenario, 300 million subscribers, or worst case scenario, 200 million subscribers. And then what we showed that if they got to those points, this would actually be what their revenue would be. This is actually what their EBITDA would be. There's some assumptions in here. The multiples wouldn't be aggressive, and you can end up with an $800 billion company, or a $400 billion company, or a $125 billion company. But quite frankly, it's pointless looking at next year's multiple, and it's pointless asking Netflix to make money, because we don't actually want them to make money. We want them to spend as much as they can so they're a chance of getting to one of these outcomes, because they're going to be one of those exceptional few. And what's happened in the 2 years previously is they've actually tracked very much towards our bull case. So they're still tracking. They've gone from 100 million subscribers to nearly 200 million. They've managed to raise the price despite all the competition. And then on top of that, you know, the revenue's more than double. The EBITDA's gone up 5 times, and the company's gone up more than 100% in value. But still looks optically expensive to the people that are looking at it, but ultimately is executing along this curve. And so from our point of view, we hope that that continues. The other thing you can do is obviously you can take this example and then go, well, what's the next one? You know, because we've seen this happen so many times now. We saw it happen with Google. We saw it happen with Facebook. We saw it happen with Amazon. We've seen it happen with Netflix. What's the next one? Let's go further up the risk curve and think about Spotify, and not say just because it's younger, it's riskier. It might actually be a better opportunity because the valuation is just so far off what's potentially out there. And in this case, you know, everyone's going to have a music streaming service. In this case, they're probably only going to have one. It's Spotify, Apple, Google, or Amazon. In the developed world, in China, it's different. And, you know, Spotify's at the lead. They've got more than 50% share at 250 million users. These are the potential opportunities. These are the potential upsides. And so you can actually see a scenario, and that you do need to probability adjust, where the company could go up 10 times in value from here, or nearly 10 times in value. And even then, it would still only be 25% of its total addressable market. And so those are some of the things we think about. The last thing I just want to say here, really importantly, okay, and this is super, super important, okay, you are going to make mistakes here, okay. There is only going to be a few winners. And your job is to find those few exceptional winners and find what they could actually be worth in the future. Not look at next year, take a longer term view and do the work. But the last and most important part of this is your risk management. You have to accept that you're going to make a mistake, and not just one, you're going to make quite a lot of mistakes. And so from that point of view, we do run, as I'm showing on the right here, this very disciplined risk management framework, whereby, you know, ultimately we're trying to work our way towards those few winners. But if they don't execute, then we recognize they'll be the loser and we need to cut them. And so what we're showing you here is our top 10 winners since inception in basis points attribution to the fund, and our top 10 losers since inception in basis points attribution. So basis points, the number of basis points it's added. And so this is a simple concept of working your way towards those few winners and running them for long periods of time. That's what we have on the right here. And on the left here, you'll see we've actually never lost more than 100 basis points in any one stock for the fund. And this really comes around this risk management process of being able to recognize that you're wrong and then to be acting on it. And then ultimately, if you do that over and over again, you're a reasonably good chance of getting you that superior risk-adjusted returns through the cycle. Sorry, Fletcher, that was a long answer.
No, all good. That's great. So thanks, Nick, for that. So this is the last question from me before we go to the audience, and it was just around the comments you made earlier that your largest structural change position or area of interest today is actually innovative health. Clients are always asking what the next structural change that Munro is focused on, which one's coming next. So maybe if you can spend a bit of time just talking about what's actually driving this structural change in global healthcare, and what companies do Munro think will be the big winners here?
Yeah, so thanks, Steve. So yes, I did mention this at the start, so thank you for reminding me. This is our biggest area today. And again, I mean, unlike the digital businesses, you do not need to pay high multiples to benefit here. There are more winners and they trade at much lower multiples because they don't have those digital characteristics. We've been looking at innovative health for a while. This is a good idea show of what our basket is. And when we talk about innovative health, what we're saying is companies that basically lower the cost of healthcare. They are solving a problem. We focus very much on life science and diagnostics companies, but also medical technology companies. They're the two areas that we were focused on most pre-COVID. The reason why is because the shift, as I showed earlier, to biological drugs is a very complicated process, and biological and personal drugs are going to be very important in the future. And so what we wanted to do here is buy the weapons manufacturers in this war. So we bought literally the company that makes the equipment, which is Danaher. The other area we focused on is companies that provide these new technologies, better technologies that solve problems easier, and hence they can charge more for them. And this just shows you, insert cardiac monitors. Those are the things we're focusing on. Since COVID, it's come to our attention that, healthcare is now front and center. We have this major global crisis. It's basically a health crisis. It's a pandemic, as Dan keeps reminding us. And so as you can see here, this is the PCR test opportunity. So the testing opportunity is huge. It's $26 billion today. And so this is just COVID testing globally. And we actually think this number's low. We actually think this number's going up. And so when you think about a test, we've had 2.7 million tests done here in Victoria. They cost $25 each. And Thermo Fisher is the major supplier of these tests, of the PCR tests. The other big test out there is the quick test, the rapid test, the one that Donald had before he had the Thermo test. And that's the Abbott test here. They're your two big winners in testing. And both of this testing opportunity is literally going to add potentially an extra 20 to 25% revenue to these companies. Once we get beyond the testing opportunity, we then move into the vaccine opportunity. We're going to need to build vaccines for 7 billion people. That could equal 7 billion vaccine shots. It actually could equal 21 billion vaccine shots if you need 3 boosters. And it could actually happen annually. This assumes just the 7 billion once. And this is the equipment suppliers, the people that build the equipment for the vaccine. So we're not betting on who's going to make the vaccine. We're betting on the equipment that's going to be required to make these many doses. And this is where Danaher really comes in. And these companies are both in our top 5. They're really sort of our Amazon and our Google of healthcare today. Just to show you Thermo really quickly. Thermo is this wonderful structural growing company. So that's the earnings growth of Thermo Fisher. That's the PE multiple. It has re-rated, but we're still only paying 26 times earnings for this company today. And so from our point of view, you can see that acceleration in earnings. And we think that's only just started. And lastly, just obviously COVID will pass. We get that. We sincerely hope it does too. But it's important to remember that then the spending will begin to prevent the next pandemic. So these companies are really going to be at the forefront of that. And they're just not that big. 172 billion is a big company, but it's tiny when you think about the problem that we're trying to solve here in the long run.
Okay, fantastic. Thanks, Nick. Now we're getting quite a few questions come through from the audience, which is terrific. So what I want to start with the first one, this is around the concentrated fund. The concentrated fund had an impressive performance period over Feb and March, losing circa 5%. Given the fund doesn't short, how was that achieved?
Yeah, so it was twofold achieved. One, the companies that we were investing in happened to do quite well. So even though I said Microsoft and Amazon were falling at the same time as Boeing and Airbus were falling, they weren't falling as much. So we were positioned, as I said, fortuitously in a lot of these areas before the pandemic. So this innovative health, digital enterprise, e-commerce, digital payments were all in the fund pre the pandemic. And all we did really was we lost ourselves out of the things that we knew were in trouble, that we didn't want to be in. So that's your Airbus, that's your luxury goods, That would be Uber that I showed you earlier. So those are the things that we stop loss out of very quickly. And then we just took that money and doubled down on the healthcare, the e-commerce and the digital payments. So we got that right on the way back up. That was the first reason why I did well, was just pure stock picking. Part of that was luck, part of that was good management. The second thing is obviously the currency. So it's 100% unhedged, whereas the long short product, it was only 50% unhedged, and the Aussie dollar fell quite a lot. And so the Aussie dollar, the falling Aussie dollar added, double digit returns to the long only product, but it only added 7% to the long short product. And so those were the key different things that helped us do that.
Okay, great. So Nick, let's move along to, I've got a question around the climate change area of interest. What makes the climate change thematic different today than say 15 years ago?
Thank you. Okay. We could get in trouble here, but
That's a good question, yeah.
oh no, that didn't work out. I'm just gonna fast forward to a slide here very quickly. Yes, so hopefully you can see that, yes?
Yes.
Yeah, so this will be our climate change basket. So why is it different this time? It's different this time not because, Biden might win the election. It's different this time because every single company we talk to is moving towards a zero carbon target. Europe is moving towards a zero carbon target. China is moving towards a zero carbon target. And I want to be clear about this. A zero carbon target doesn't mean you reduce less CO2. It means you reduce no CO2. And so Europe, to give you an idea, these will be our basket of companies that we think are going to benefit from it. These are the areas of interest that we think they will cross, and they completely cross sectors and regions and countries, if that makes sense. When we think about Europe in general, Europe wants to go to zero carbon by 2050. I think they have zero chance of actually doing this. It's going to take a lot longer than that. But we think it could cost them up to $7 trillion in investments. And there's plenty of white papers being announced as to what this could do. And these are the areas where the money could be spent. And a lot of people really focuses on electric cars, which are passenger EV, but there are lots of other opportunities in things like energy efficiency, renewable energy, charging stations, etc. And so I would just say that the momentum behind going to zero carbon is now stronger than I've ever seen it before. And I effectively think we've reached the tipping point. And it's not just important to countries and policymakers, it's important to companies, it's important to stakeholders, and it's important to employers. And so the reason why we're excited about it is if you go back over the last 20 years, the internet has really spanned. It's been that one big structural change that has spanned up my whole career and spawned all these great new structural winners. When you think about climate, we're at the start of the next big one. Like if they actually do what they say they're going to do here, then inevitably, as I go back one, many of these companies on these slides are going to be dramatically bigger. And they're going to be the ones that are appearing in the top left of that slide that I showed at the start, 10, 20 years from now.
Okay, great. All right, let's move across to the US election. I've got a question here. How do you think the market would react to a contested US election?
Badly. In short, sorry, let me just, and please, I'll just head back to where I was before. So from our point of view, it would react badly. We would be left, trying to protect the downside. So the obvious thing to do would be just short some futures or to raise some cash levels. Why would the market react badly? Just purely for the uncertainty. In the same way, we saw a microcosm of it the other day when Donald Trump tested positive for COVID. It just increases the uncertainty. We don't particularly want, Mike Pence running the country. We don't particularly want the Supreme Court deciding what's going to happen in the US. So in the short term, it would increase uncertainty dramatically, and we'd have to do something about that. In the long term, it's not going to change any of these things happening. In the long term, it's not going to change, the fact that we're going to use more cloud computing, or that we're going to buy more stuff online, or that that semiconductors are going to become more and more important in how we do business. So from that point of view, it doesn't really change anything, but in the short term, it would increase uncertainty dramatically.
Okay. So a question around China. Are you bullish on growth in China, both short and long term? Are you tracking potential winners in China that you don't currently own?
Yes, so thank you. That's a great question, and something I didn't mention, so I'm glad. The one thing, if you look at this slide and how we're positioned, we would say we slightly favor Biden winning the presidency. We would prefer that they didn't win the Senate, so a bit of gridlock, but a bit of a sentiment boost for our climate stocks would be helpful. We don't think it really needs it. It's going to happen anyway. But the other reason why we'd slightly prefer that is because China's just a super exciting place to invest right now. And so the Trump regime have been very hard on China. We've owned Alibaba, for instance. People may have seen it before as one of the biggest stocks in the fund. We've owned this company for three and a half years. It's been, up until recently, a very difficult stock to own. But slowly over time, they've taken the company away from its US listing to Hong Kong. They're now going to be listing Ant Financial on the Star Exchange in Shanghai. And ultimately listing Alibaba, we think, on the Star Exchange in Shanghai, which will be very, very positive for these Chinese stocks, because for the people who are listening, the Chinese individual will be able to actually buy his own national champion. In the same way we own BHP or CBA shares growing up, the Chinese person can own Alibaba. We think that's going to be a huge event. And that's actually happening at the end of this month. On top of that, that'll be very positive for Tencent as well, and Ant Financial. And so when we look at China, the beauty of China is they are effectively building the whole tech stack that we see in the world themselves. And so that's going to create some great opportunities. So we know who the Amazon of China is, it's Alibaba. We know who the Facebook is, it's Tencent. But who's going to be the Microsoft? Who's going to be the Salesforce.com? Who's going to be the semiconductor company? And so, yeah, we do see some really good opportunities there. And we know that if Biden won, then, we wouldn't have to wake up to all these headlines the whole time, the whole way through. So that would be our slight preference, but it's not the end of the world. Again, this is going to happen anyway. So at the moment, we have roughly 13% of the fund, or 12% of the fund in China. I can see a scenario where we could be closer to 20, 25% at some point in the future. It's just a matter of finding the right ideas to go in, and Ant Financial will probably be the next one.
Okay, we've actually got a question on Ant Financial, but we've got a number of questions as well, which we probably won't get to today because we are getting close to the end of the hour. So for all the questions that we haven't answered, we will come back to you with a response. But thank you for submitting those. Nick, just before we wrap up the call today, is there any any final comments you want to make just to wrap up the session?
Yeah, so sorry we didn't manage to get to all the questions. I apologize, I probably talked too long in that middle section. But I think at the end of the day, if you're looking at our fund, you should look at this slide that we have in front of you. We update it quite regularly. In all of these areas, we think we've got the right areas of interest. We think we have the areas of structural growth in the future. And look, we understand that, there'll be rotations or there'll be short-term effects. But over the journey, I think most people would agree that we're in the right areas. We've worked very hard to find the right stocks. In some cases, we have to look to go a bit further up the valuation curves. In other cases, we don't. And so we work very hard to get the balance here. So Microsoft's a big position here, but Atlassian is also. So some of them are expensive and some of them are not. But ultimately, we think they are those eventual winners. The last thing I'd just say, I'm on the wrong slide. The last thing I'd just say is ultimately we want to be your global growth investor. And we want to fill that hole in your portfolio. And we do encourage you to look at the website where we're being very transparent about what we're doing and ultimately update our thoughts over time, because we enjoy doing what we do and we want to spend a long time doing it. And we're happy to share that with people as we have today.
Terrific. Well, thanks very much, Nick. Ladies and gentlemen, thank you for once again for joining the call. We hope you found it of value. If you could provide us with some feedback, we'd love to hear your feedback for future sessions. Once again, on behalf of GSFM and Munro Partners, thanks for your ongoing support. We are very excited about the upcoming launch of the ETF, so you'll hear more about that in the coming weeks. But once again, thank you, and we look forward to speaking with you all again very soon. Thank you.
Thank you.